Hey guys, Joel Frank here, market analyst for YouTrading, and this is the midweek market update. So let's jump straight into it. We'll start off by looking at US equity markets, or I've got here the S&P 500. And for global equity markets, and particularly US equities, it's been all about earnings so far this week, guys. As you can see by the reaction in the stock market, like we've just been pressing higher at just an astonishing rate in the last couple of sessions, in the last sort of 2 weeks. And we've managed to convincingly break above those previous record highs from early September this week as well. And that's been mainly because the earnings season has been broadly positive. I wrote this in the brief this morning, but we've had a few more earnings out this morning. But as of yesterday, 166 S&P 500 companies had reported earnings, and 139 of them, those earnings had been stronger than expected. We've also had quite a lot of big tech this week as well. We've already had Microsoft, Facebook, who was the other big one, and Alphabet, and broadly speaking, that's been positive. We've still got Apple and Amazon, both of them reporting on Thursday. So earnings still very, very important. I mean, we're right in the middle of the earnings season, really. But for now, things have been positive, and that's helped. It's kind of helped equities, helped shield equities from some of the concerns being seen in other regions of the world or in other markets. Remember back in September when equities were coming back from recent highs, we were talking about inflation, central bank tightening, high energy prices, weaker growth. Well, those themes haven't gone away, but what has dissipated is some of the fears that all of those negatives are going to be causing corporate America to suffer. Well, corporate America seems to be able to, demand seems to be strong, and any increased input costs as a result of all this inflation we're talking about, it seems as though companies are being able to pass those costs on and maintain their profit margins. But this is an ongoing theme, and if stocks are going to continue to press higher, as you can see that the rally has kind of faded today and yesterday, we're going to need to see earnings continue to be very, very good. And to be honest, after such a strong run to the upside, I wouldn't be surprised to see stocks dip back a little bit, perhaps towards this support here around 4,500, or perhaps even a little bit low. That wouldn't be a signal that the bull run is over. It would potentially provide a buy the dip opportunity, but I would just caution that some profit taking is probably overdue. But yeah, moving on, bonds. Some interesting price action in bonds this week. I haven't got the chart here, but short end US bond yields have been moving higher as markets continue to price in a front-loaded hiking cycle from the Fed, and we're also seeing that trend happening in other markets like the UK and Canada, and anywhere where the central banks aren't super dovish, like in Japan or in Europe. But longer-term bond yields have been moving lower in the last couple of days. I think the US 10-year yield is now on course to drop for 4 days in a row. And you can see that here. This is the 10-year bond price. Remember, yields and price move inversely to each other. So looks like we're going to have gone up for 4 days in a row, pretty much. And just from a technical perspective, the Treasury is now above its 21-day moving average here in orange. Looks like it's trying to test this recent sort of downtrend. And if it does break above that, then potentially we could be looking at a test of resistance here from the 14th of July, which also kind of coincides with the 200-day moving average there as well. So yeah, potentially if we break above, there could be some technical buying for bonds. But as long as because just looking at inflation expectations now, they continue to rise, and expectations for economic growth in the US remain pretty healthy. Like yesterday, we had a very strong, or stronger than expected, US consumer sentiment survey, which is a good indicator for growth in the coming months. Well, as long as that economic situation remains positive and hawkish Fed expectations remain alive, you would probably suspect that yields are eventually going to come down again. We've got a double bottom here in the Treasury. Potentially, if that breaks, we could then be in for a look at yearly lows down here. But that's going to be a slow burner. Moving on, what's the dollar been doing? Well, as you can see, these are daily candlesticks again, like the other charts we've been looking at. Things have been very, very subdued for more than a week now. To the upside, the price action has been constrained by the 21-day moving average. To the downside, and that, by the way, coincides roughly with the 94 level. To the downside, the DXY just doesn't want to break below 93.50, does it? You can see that's actually a decent area of support now. And just below it is the 50 DMA at 93, well, in the 93.30s. So things have been very, very range bound. And that does make sense, to be honest, because we've got a lot of important central bank action coming up from the G10. We've got the BOC today. They're going to taper their QE further and probably put their QE tapering on course to end by the end of the year. But the main focus with the BOC is on their guidance for interest rate hikes, because at the moment they're saying interest rate hikes could happen from the second half of next year, but money markets are pricing interest rate hikes in the first half of the year. So there's a bit of a mismatch between what markets are saying and what the Bank of Canada is saying. So it'll be interesting to see if they can match market expectations by being more hawkish. And if not, then the CAD might sell off a little bit. That's not too important for the DXY, but the Bank of Canada is not the only central bank coming up. We've also got the ECB, the BOJ, and next week, neither of them are expected to do anything. But next week, we've got the Fed, who are expected to announce their taper, and we've got the Bank of England, who might hike rates. So we've got a lot of important central banks coming up, and that is keeping FX conditions broadly quite subdued, which is what you're seeing here with the DXY. You would suspect, I mean, a lot of strategists suspect that as long as the Fed's expectations for the Fed's tightening timeline with QE and eventual rate hikes in the second half of next year remains as is and remains way more hawkish compared to, say, the ECB and the BOJ and the SNB, well then the dollar should probably continue to strengthen over time against the euro, against the yen, and against the Swiss franc. Maybe not against the pound and some of these other currencies that are more risk sensitive, but they make up a much smaller weighting within the dollar index. So that means we should probably see the dollar continue to pick up over time. But maybe there's a lot of people that are long the dollar, so maybe we do need a bit of a clear out of long positions. So then maybe people can buy the dip somewhere down here. But anyway, just quickly, last but not least, crude oil prices. You don't even need technicals for this. It just continues to rally. Obviously, we've got this global energy crunch with fossil fuels. There's shortage of natural gas, potentially in the US now, definitely in Europe. There's coal prices, which have been all over the place in China. They're actually 40% off recent highs, but still probably about 50% up on the start since the beginning of the year in China. OPEC aren't bringing online supply as quickly as people want, and pretty much the trajectory for crude oil probably remains to the upside, although you could maybe see some profit taking because this recently, over the last couple of weeks, it's been a straight line up, hasn't it? So a bit of a flush out of long positions potentially. We've got some support here just above the $80 per barrel mark. That could be a good area for longs to pile back in and then send us to the $90 per barrel level. But anyway, yeah, guys, hope you enjoyed this briefing, and I'll see you all in the next video.